Canadian mortgage rates just spiked above 4% in 2 days, driven by a global energy crisis that one analyst calls the biggest since the 1970s. Good evening, I'm Steve, and this is the Daily Brief Canadian Macro. Today we're covering three major developments affecting Canadian investors. First, the David Lin Report breaks down how the Strait of Hormuz closure is creating unprecedented energy market volatility. Then Market Mania dives into BMO's assessment of Toronto's condo crash, with some suburban areas down over 50%. And Mark Mitchell explains why mortgage rates just jumped 35 basis points in 48 hours. Let's start with the global energy picture. Today, the David Lin Report covered what they're calling the biggest energy shock since the 70s, triggered by the Strait of Hormuz closure. Their core argument is that this crisis exposes how fragile global supply chains create strategic vulnerabilities that adversaries can exploit. The data here is striking. The strait handles 20% of global oil shipping, and countries like Vietnam, Bangladesh, and the Philippines are estimated to run out of oil within 3 weeks. What's particularly interesting is how presidential social media is creating unprecedented market volatility. Brent crude plunged $17 per barrel in under an hour after Trump posted about productive Iran talks. The David Lin Report also highlighted a connection most investors miss. Qatar supplies 30% of the world's helium needed for semiconductor manufacturing, while South Korea getting 55% and Taiwan 69% of their helium from the Gulf region. This gives us a framework for understanding how energy disruptions can cascade into tech supply chains. For Canada specifically, this cuts both ways. As a major oil exporter, a prolonged Hormuz disruption could support energy prices and Alberta's fiscal picture, but the inflation it exports globally is already showing up in Canadian bond yields, and that brings us directly to what's happening in Toronto's real estate market. Over on Market Mania's channel, they featured BMO economist Robert Cavick's assessment of Toronto's condo market, which he declared absolutely dead. Their main thesis is that we're seeing a full-scale condo market crash that's spreading beyond subprime borrowers into higher credit score homeowners. The numbers are extensive. Toronto condo prices have crashed 9.5% year over year and sit 25% below their early 2022 peak. But the suburban data is where things get severe. Pickering condos have fallen 57.4%, from $1.1 million to $468,000. Market Mania also reported that real estate agents are seeing significant emotional distress, with individual power of sale losses ranging from $520,000 to $784,000 per home. What's notable is that higher credit score homeowners in the 621 to 680 range are increasingly defaulting, with near-prime borrower delinquency rates up 31% year over year. This connects directly to our next topic about rising mortgage rates. Mark Mitchell focused on the mortgage rate spike that just hit Canadian borrowers. His argument is that mortgage brokers are irresponsibly pushing variable rates based on hope rather than financial reality. The immediate trigger was war-driven inflation fears. 5-year Government of Canada bond yields jumped 35 basis points in just 2 days, pushing fixed mortgage rates above 4%, with nothing below that threshold available anymore. Mitchell pointed out that variable rates still offer prime minus 0.8 to 1%, creating about a 1% spread advantage over fixed rates. But he criticized brokers for using what he calls the appeal to authority fallacy, making predictions without evidence. His key insight was that fixed rates have increased 0.06% since the conflict began in February, now sitting at levels similar to August 2022, when variable rate usage collapsed. Looking across today's analysis, Canada finds itself in an unusual position, exporting the commodity that's driving the inflation that's now threatening its own real estate market. The David Lin Report shows how presidential social media posts can move oil prices $17 in an hour, while war-driven inflation fears have already pushed Canadian bond yields and mortgage rates above 4% in just 2 days. Market Mania's condo crash data becomes more concerning in this context. Higher credit score borrowers are defaulting at increasing rates just as borrowing costs spike. The stress test on Canadian real estate was already underway before this week. The energy shock isn't creating the problem, it's accelerating it. For investors watching the condo market, the question isn't whether prices fall further. It's whether rising borrowing costs will pull a broader group of homeowners into distress before the Bank of Canada has room to respond. Watch this week whether bond yields stabilize or continue climbing. That will tell us a lot about how much pressure is still coming. That's today's brief on Canadian macro developments. All credit goes to the creators featured today for their original analysis and research. You'll find links to their full videos in the description below. If you found this video helpful, please subscribe, Hit the notification bell so you don't miss tomorrow's brief, and don't be afraid to comment if there's another creator you think deserves a highlight here. I'm Steve. As always, nothing here is financial advice. Everyone's situation is different, so please do your own research and talk to a qualified financial advisor before making any investment decisions.